Okay, now let's try and understand the next topic, which is options. Now, options are one of the best derivatives available today that people trade with in the capital markets. But before we try and understand options, I think we should understand a little background about where options originated from. Options originated from the product which is insurance. Okay, so let's try and understand how does an insurance product works, after which we'll try and understand and correlate it to how option as a product works. So let's try and understand about a general insurance policy, which is car insurance. Okay, so how does a car insurance work? So in car insurance there is the first party, which is owner of the car. There is this another party, which is the insurance company. Okay, now owner of the car first. Owner of the car pays the premium to get an insurance policy, and the insurance company receives the premium. Owner of the car is the buyer of the insurance policy, and the insurance company is the seller of the insurance policy. So we are saying the seller receives the premium and the buyer pays the premium. Now, why is the owner of the car going to is willing to go ahead and buy an insurance on the policy? Because he assumes that the car might meet with an accident. So based on this assumption, he wants to protect his risk, which is that if the car might meet with an accident, who will pay for the cost that will be incurred? So the owner of the policy has an assumption that the car might meet with an accident, which is the risk, because of which he takes the policy from the seller. So now what happens in this car insurance policy per se? So if what the buyer assumes that the car might meet with an accident happens, then the seller pays the buyer. So suppose if the car meets with an accident and there is an X loss, that X loss is taken care by the seller. Now what if what the buyer was assuming that the car might meet with an accident does not happen? Okay, what happens in that case? In that case, the premium that the buyer paid to the seller is fully lost. Just to repeat the concept all over again, in the car insurance policy there are two parties. Party number one is the owner of the car, and party number two is the insurance company. Party number one is the buyer of the insurance policy. Party number two is the seller of the insurance policy. Whoever is the buyer pays the premium. Whoever is the seller receives the premium. Okay. Why is the buyer taking an insurance? The buyer is taking an insurance because he assumes something. In this case, he is assuming that his car might meet with an accident, which is a risk. So if what he is assuming comes true, okay, the seller pays the buyer. But if what he was assuming, which is the car might meet with an accident, does not come true, whatever premium that the buyer had paid the seller is completely lost. That is exactly how options as a product works. Okay, now let's try and throw more light on option as a product. So there are two type of option products available. First is called call option, another is called put option. Now try and understand, this is one completely different product and this is one completely different product. So if call is one different product, for this particular product there has to be a buyer as well as a seller. Similarly, if put is a completely different product, we should have a buyer of the put product and seller of the put product. Correct? Now, what I want you to understand is call. When I say call, okay, I am assuming a buy. Okay, so who will buy? Anyone who's expecting the markets to go up will buy. Right? When I say put, I am saying sell. So call as a product is biased towards people expecting the markets to go up, and put as a product is biased towards people expecting the markets to go down. Okay, so whoever is buying this particular product is expecting the markets to go down, and whoever is buying this particular product is expecting the markets to go up. So call is a buy. So whoever buys the call is expecting the market to go up. Put is a sell. So whoever is buying the put is expecting the markets to go down. So buyer of the call option is expecting the markets to go up. If the buyer is expecting the markets to go up, the seller is expecting the markets to go down. Buyer of the put option is expecting markets to go down. So the seller is expecting the markets to go up. So now what I want you to understand, whoever is buying the call option will make money when the market goes up. Whoever is selling a call option will make money when the market goes down. Whoever is buying a put option will make money when the market is going down. Whoever is selling the put is going to make money when the market goes up. So buyer of the call option expects the market to go up. Seller of the call option expects the market to go down. Buyer of the put option expects the markets to go down, and seller of the put option expects the market to go up. Are we clear? Great. Now let's go a little deeper into the subject. Okay, so let's try and understand a little more about options now. Say for example, we have this particular stock trading in the market at 100 rupees right now. You are expecting the stock to go up. So what can you do? You can buy it in the cash market. You can buy it in the futures market. And you can also buy a call option. Okay, so let's assume that you bought this particular stock at a strike price of 100 rupees. X stands for strike price or contract price or exercise price. They all mean the same, which means that you've entered into the contract at 100 rupees, and whatever you are expecting, whether the markets to go up or down, will be with respect to this 100 rupee price. So now that you are buying a call at 100 rupees, you are expecting the markets or this particular stock to go above 100 rupees. We understood when we were trying to understand insurance as a product that whoever buys will have to pay a premium. So let's assume you pay a premium of 2 rupees. Okay. Now, like you expected, the stock goes up and closes in the market at 110. So you bought it at 100 by paying 2 rupees premium. You were expecting it to go above 100. Now it actually went above 100 like you were expecting, it goes to 110. So how much profits do you make? So you bought it at 100, went to 110. So 110 minus 100, you make 10 rupees profit, but you've paid 2 rupees as premium and you make 8 rupees as profit. Now a lot of you all will be wondering that why will someone trade in the options market when the same trade can fetch you a higher amount in the futures or the cash market. Suppose if you would have bought this same stock at 100 rupees in the futures market, when it goes to 110, you could have made 10 rupees as profit versus 8 rupees over here in the options market. Even in the cash, you would have bought it at 100, sold it at 110, you would have made 10 rupees profit. Then why do people trade in the options market when the profit is less than the cash market or the futures market? People trade in the options market because of the downside risk. Say for example, you bought it at 100, were expecting it to go above 100, but unlike your expectation, the stock went down to 50 rupees. If the stock goes down to 50 rupees in the cash in the futures market, you will lose 50 rupees. If it goes down to 50 rupees in the cash market, you will lose 50 rupees. But what happens in the options market? In the options market, you lose only your premium, which is 2 rupees. So your loss is only 2 rupees. Why? Now let's try and understand again. So you took an insurance policy because you thought your car might meet with an accident. So if what you were assuming that your car might meet with an accident actually happens, the seller will pay you the amount of money. So when what you were expecting happens, the seller pays you. But when what you are expecting does not happen, so like you were expecting that your car will meet with an accident, but it does not meet with an accident. So what as a buyer you were expecting does not happen. What do you lose? You lose only the premium. That's how the insurance policy works, right? That's exactly how the options market works. I was expecting the stock to go above 100. When it goes above 100, I make money, 8 rupees. But when what I was expecting does not happen, so I was expecting it to go above 100, but it does not go above 100. What do I lose? I lose only the premium, which is 2 rupees. Okay, so in the cash market and in the futures market, you have unlimited risk. Okay, but people trade in the options market because as a buyer your maximum risk is the premium that you've paid. So I hope you've understood the prime reason because of which people trade in the options market, which is to protect their downside risk. That means if the stock goes to 110, their profit is unlimited as a buyer, correct? But if the stock goes in the opposite direction, your maximum loss is your premium, which is limited. So as a buyer in the options market, your profit is unlimited and your loss is limited, because of which people trade in the options market. Now let's try and understand a little more about the options market. So I bought the call at 100 rupees, okay, by paying a premium of 2 rupees. Let's assume if the spot closes in my favor, like say 101, 102, 103, 104, 105, 106, 107, 108, 109, 110. What is my profit and loss? And if it does not close in my favor, let's say it closes at 90, 91, 92, 93, 94, 95, 96, 7, 98, 99 and 100, what's my profit and loss? So when I buy a call, I'm expecting the markets to go up. Above which price? 100, because 100 is the price at which I have done the transaction. Just to remind you all again, as a buyer, if what I am thinking that my car might meet with an accident happens, I make money. And as a buyer, if what I was thinking does not happen, I lose premium. Because if my car does not meet with an accident, the amount of money that I paid to the insurance company is lost, right? So when I am a buyer of the call option, I am expecting the markets to go up. Above which price? 100, the price at which I have entered into the contract. Okay, so if it goes up and closes at 101, what is my profit and loss? I was expecting it to go above 100, it is 101. Okay, so 101 minus 100, I make 1 rupee profit, but I have paid 2 rupees of premium, so my net is minus 1. Okay, what happens at 102? I'm expecting it to go above 100, it goes to 102, so 100 minus 102, I make 2 rupees of profit, but I've paid 2 rupees of premium, so 0. So 102 becomes my break even point. What happens at 103? So 103 I make 3 rupees, I paid 2 rupees of premium, so my profit is 1 rupees. At 104 I make 4 rupees, 2 rupees of premium paid, so 2 rupees profit. At 105, if the spot closes, 5 minus 2, 3. At 106, if it closes, 4. If 107, if it closes, 5. 108, 6. 109, 7. 110, sorry, 110, I make 10 rupees minus 2, which is 8 rupees. So as a buyer, my profit is unlimited, because even if it closes at 1000, so 1000 minus 100, which is 900, I have paid 2 rupees of premium, so my profit is 898. So my profit as a buyer is unlimited. Now what if it moves in the direction opposite to what I want it to move in? So let's assume it moves in the downward direction. Okay, so what happens in that case? Suppose if it closes at 100, what is my call? My call is that I am expecting the markets to go above 100. Okay, which is above 100. So if what my call is and it goes wrong, what do I lose? Maximum. Maximum I lose is my premium. So I'm expecting it to go above 100, and if the spot closes at 100, is my call right? No, my call is wrong, because I was expecting it to go above 100. At 100 my call goes wrong, so what do I lose? Minus 2, because maximum loss as a buyer is premium. 99 also my call is wrong, because I was expecting it to go above 100, so what do I lose? Minus 2. So if it closes at the X or below the X, how much do I lose? Maximum I lose minus 2. So at a price at 100 or below 100, what do I lose? 2 rupees. At a price above 100, I start breaking even and then start making profits. I hope it is absolutely clear to you. Now, if for any trade to happen, there has to be a buyer and a seller, correct? So if the buyer is making 2 rupees, who pays the 2 rupees? Seller. So the seller is minus 2. So whatever is the buyer's situation, exactly opposite is the seller's situation, right? My sincere advice to everyone viewing this video is, don't try and look at the seller's situation ever. Always look at the buyer's situation and try and make it opposite, which will give you the seller's situation. So say for example, if there was someone who sold the call at 100 rupees and received 2 rupees premium, okay, what if the spot closes at all the prices that we've discussed now? What is going to be his profit and loss? What will I do? I will think of it from the buyer's point of view, get all these answers, okay, get all these answers, and I will reverse it and will say it is seller situation. So if I was the buyer of the call option at 90, I lost 2 rupees, who will receive this 2 rupees? Seller. So seller is plus. At 91 the seller is plus, 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 plus. So if I am selling a call option and the stock stays at 100 or below 100, I will receive 2 rupees, because the buyer is losing 2 rupees. So all the situation will be reverse of what it was in the case of buying. Okay, so if I am the seller of the call option and the stock closes at 101, I will make 1 rupees. At 102 I break even. At 103 I lose 1, lose 2, lose 3, lose 4, lose 5, lose 6, lose 7, lose 8, and lose 898 rupees. So what am I trying to explain to you all? Any situation given to you, think from the buyer's point of view, do the calculation, okay, and change the sign, which is the seller's situation. Are we understanding? Let's do one more example to clarify the thought even further. So let's say now the call option is for 50 rupees, premium is 1. Okay, let's assume if the spot closes at 50, 51, 52, 53, 54, 55, or it closes at 49, 48, 47, 46, 45. Okay, if you were a buyer of the call, what is your profit and loss? And if you were the seller, what is your profit and loss? If you were the buyer, what is your profit and loss? If you were the seller, what is your profit and loss, is what we'll try and understand now. Okay. So if you were the buyer, of the call option, what were you expecting? Markets to go up above 50. So if it does not go above 50, your car is not meeting with an accident, and when your call as a buyer goes wrong and your car does not meet with an accident, you lose your premium. So you are expecting it to go above 50, it stays at 50, so you lose the premium that you paid 1 rupee. Now if you are losing the premium, who's getting the premium? Seller. So if someone who sold the call at 50 will make 1 rupee as profit if the stock is at 50 rupees. Okay. What happens at 51? At 51, you were expecting it to go above 50, it went about 50. So 50 and 51, you make 1 rupee profit, but you've paid 1 rupee, so your net is 0. So this will also be 0. At 52, you make 2 rupees, but you've paid 1 rupee, so you make 1 rupee. So who pays you this 1 rupee? Seller. So the seller situation is -1. At 53, you make 3 rupees, but you've paid rupees, so you make 2 rupees of profit as a buyer. Who pays you this 2 rupees? Seller. So the seller situation is -2. Over here you make 4, -1, 3. Who pays you this 3? Seller. 5 -1, 4. Who pays it to you? So as a buyer of the call option, this is my situation, and the same data, if I am a seller of the call option, this is my situation. So what am I asking you all to do? Think from the buyer's point of view, change the signs, which is the seller's point of view. Okay. Suppose if you were the buyer expecting it to go above 50, okay, but it does not go above 50. So you are expecting your car to meet with an accident, it does not meet with an accident. Your call goes wrong. What do you lose? The premium that you paid to the insurance company. You are expecting it to go above 50. It does not go above 50, it goes below 50. So what you are expecting as a buyer does not come true. When you, whatever you expect as a buyer does not come true, what do you lose? Premium paid to the insurance company. So you lose 1, you lose 1, you lose 1, you lose 1, you lose 1. Who receives this one? The seller. So the seller situation is, so if this is the given data, if this is the price at which it is closing in the market, at which you have to do the calculation, my suggestion to you is think from the buyer's point of view, change the signs, and it is going to be the seller's point of view. So 51 becomes your break-even point for this particular given situation. I hope it is absolutely clear to all of you. So what I also want you to understand is, as a seller, what is your maximum profit? The maximum profit you can make as a seller is the premium. What is your maximum loss? You can lose unlimited amount of money as a seller. So what are we trying to say? We are trying to say that as a buyer, your profit is unlimited and your risk is limited maximum to premium. But as a seller, your profit is maximum up to the premium, which is limited, and your risk is unlimited in any direction the stock moves. So as a buyer, your profit is unlimited, risk is maximum the premium, which is limited. As a seller, your profit is maximum the premium and your risk is unlimited. Let's do the same exercise for put. Okay, so suppose if the price at which I want to transact in the options market is 100 rupees and the premium is 2 rupees. Now we'll try and understand that if the spot closes at various prices like 100, 101, 102 and so on, then what is going to be our profit and loss as a buyer of the put option or the seller of the put option, and vice versa. Okay. Or if the spot closes at 90, 91, 92, 93, 4, 96, 97, 98 and 99. So let's assume if I was the buyer of the put option, what will happen? If I were the seller of the put option, what will happen? If I was a buyer of the put option, what will happen at these prices? If I was a seller, what will happen at these prices? So we are assuming if it closes at 100, what will happen? At 101, what will happen? And so on. So if it closes at 100 and you were the buyer, what happens? Just to revise once again, you have a car, you've bought a policy, you've paid a premium, you are assuming that the car might meet with an accident. So if what you were assuming happens, you get paid. If what you were assuming does not happen, you lose premium. Okay. So as a buyer of the put option, what are you expecting? If you've bought the put at 100 by paying 2 rupees, you are expecting markets to go below 100. So if it closes at 100, okay, your call is wrong because you are expecting it to go below 100. So if your call is wrong and your car does not meet with an accident, what happens? You lose your premium. You will lose your premium. So your call is that the stock will go below 100. Is the stock going below 100? No. So what is your loss? Premium. Is it going below 100? What is your loss? Premium. 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 Premium and premium. So if you are losing 2 rupees, if someone who's sold a put at 100, and if it closes at 100, his situation is going to be plus 2, plus 2, plus 2, plus 2, plus 2. So what am I trying to tell you all again is, even if the question says that someone sold put at 100 and received 2 rupees premium, first calculate the buyer's angle, change the sign, that's your seller's angle, because this is going to be more simpler than calculating independently for the seller. Okay. So as a buyer of the put option, you are expecting markets to go down below 100 and market actually closes at 90, which is what you were expecting. What happens? So you were expecting markets to go below 100. So market has actually gone below 100. You make a profit of 10 rupees, but you've paid 2 rupees, so you make a profit of 8 rupees. At 91, 100 minus 91 is 9 rupees, minus 2 rupees premium paid, so you make 7. Over here, 100 minus 98, you are expecting it to go down, so 100 minus 92 is 8, minus 2 you make 6 rupees, 7 minus 2 you make 5 rupees, 6 minus 2 you make 4 rupees, 5 minus 2 you make 3 rupees, 4 minus 2 you make 2 rupees, 3 minus 2 you make 1 rupee, 2 minus 2 you make 0. So this is your break even point. 1, you are expecting it to go below 100, it goes below 100, 99, so you make 1 rupee, but you've paid 2 rupees of premium, so your loss is minus 1. What is the seller's situation? Exactly opposite of what the buyer's is. So minus 8, minus 7, minus 6, minus 5, minus 4, minus 3, minus 2, minus 1, 0, plus 1. Think from the buyer's point of view, and completely opposite is a seller's situation. I hope it is absolutely clear to all of you all. Let's solve one more example. So contract is at 50, premium is 1 rupees. Let's assume if the spot closes at 50, 51, 52, 53, 54, 55, what will happen? And if it closes at 49, 48, 47, 46, 45, what will happen? So what will happen if I am the buyer of the put option? What will happen if I am the seller of the put option? What will happen if I am the buyer of the put option? And what will happen if I am the seller of the put option? So let's do this math. When I'm buying a put, I'm expecting it to go below 50. So if it stays at 50 or below 50, my call is wrong. And as a buyer, if my call is wrong, I lose premium. So at 50 or sorry, at 50 or above 50, I lose my premium. Because buying a put, I'm expecting markets to go down. So if it stays at 50 or above 50, my call goes wrong as a buyer and I lose my premium. So at 50 and above 50, I will lose my premium. As a seller, who receives this premium? So seller situation is going to be +1. As a buyer, I am expecting prices to go down. So below 50, when it goes to 49, I make 1 rupee. But I have paid 1 rupee of premium, so 0. This is the break-even point. At 48, I make 2 rupees because I am expecting it to go below 50. It goes to 48. So 2 rupees, I paid 1 rupee premium, so 1. 3 minus 1, 2. 4 minus 1, 3. 5 minus 1, 4. So as a seller, -1, -2, -3, -4 is my situation. I hope it is absolutely clear to all of you all.